In this video, I'm gonna break down everything about investing in REITs. Real estate investment trusts, or REITs, can be fantastic ways to add both growth and income to your overall portfolio while adding diversification at the same time. So, let's do it. Hey there, my name is Ken. Here I talk about personal finance and investments. If you are new here, check out my other videos, and if you like, subscribe for more in the future. Before we get started, it's important to know that REITs aren't the same as most other dividend stocks, and it's important to learn the basics. With that in mind, this is a guide to what investors need to know about REITs. So, what is a REIT? A REIT, or real estate investment trust, is a unique type of company that allows investors to pool their money to invest in real estate assets. Some REITs simply buy properties and rent them to tenants, others develop properties from the ground up, and some don't even own properties at all, choosing to focus on the mortgage and financial side of real estate. Although this is an oversimplification, you can think of real estate investment trusts like a mutual fund for real estate. Hundreds of thousands of investors buy shares and contribute money to a pool, and professional managers decide how to invest it. In simple words, the purpose of REITs is to allow everyday investors just like me and you to be able to invest in real estate assets that they otherwise wouldn't be able to. For example, could you go out and buy a high-rise office tower or shopping mall? Could you buy a portfolio of mortgages, or would you even know how to go about doing this? Probably not. However, REITs allow you to put your money to work in these ways. You can even gain exposure to billion-dollar commercial property portfolios with just a few $100s to start. And there are several good reasons why REITs should be in every long-term investor's portfolio. They include: for starters, REITs can be a source of reliable, growing income. Because most property-owning REITs lease their properties on a long-term basis, REITs can be nicely set up for steady income quarter after quarter. REITs can be a smart way to add diversification to your investment portfolio. They are technically stocks, but they represent real estate assets. And real estate is generally considered a separate asset class that isn't closely coordinated with the stock market. If you want to invest in real estate, REITs can be a very easy way to get started. You can buy shares of any publicly traded REIT with the simple click of a button and without any ongoing maintenance worries. And before we go any further, let's take a minute to discuss the two different classifications of REITs. As we'll see later, there are REITs that specialize in a wide variety of asset types, but all REITs can be dropped into one of two buckets. First, equity REITs are the type of real estate investment trust that own properties as their primary business. For example, a shopping mall REIT or a senior housing REIT would be considered an equity REIT. Going forward, you can assume the term REIT refers to equity REITs unless specified otherwise. Second, mortgage REITs invest in mortgages, mortgage-backed securities, and other mortgage-related assets. Generally speaking, these companies borrow large amounts of money at lower short-term interest rates and use this money to purchase 15 or 30-year mortgages that pay higher rates. These are very different investments than equity REITs. In fact, they aren't even classified as being in the real estate sector. Mortgage REITs are considered to be financial stocks, just like banks and insurance companies. And there are few REITs that own both property and mortgage assets, and these are known as hybrid REITs. However, the overwhelming majority of REITs invest in either one type of real estate asset or the other. Now let's review types of REITs to invest in. There are REITs that allow you to invest in just about any type of commercial property you can imagine. There are mortgage REITs, residential REITs, office REITs, industrial, healthcare, self-storage, retail, infrastructure, timberland, hospitality, data centers, specialty, and diversified REITs. REITs can be excellent ways to add income and growth to your portfolio without adding too much risk, but there is no such thing as a perfect investment. Like other types of investments, REITs have pros and cons, so let's go over the main points of REIT investing. That being said, here are some of the most important REIT benefits for investors to know. First one would be no corporate tax. To be classified as a REIT, a company needs to meet some strict requirements. For example, they have to invest at least 3/4 of their assets in real estate and pay at least 90% of their taxable income to shareholders. If it meets these requirements, a REIT gets a big tax advantage. No matter how profitable a REIT is, it pays zero corporate tax. Second one would be high dividend yields. Since REITs are required to pay at least 90% of taxable income to shareholders, they tend to have above average dividend yields. It's not uncommon for a REIT to have a perfectly safe dividend yield of 5% or more, while the average stock on the S&P 500 yields less than 2%. Another benefit is total return potential. REITs have the potential for capital appreciation as the value of their underlying assets grow. Real estate values tend to increase over time, and REITs can use several strategies to create additional value. They might develop properties from the ground up or sell valuable properties and redeploy the capital. This, combined with high dividends, means REITs can be excellent total return investment. Several REITs have generated total returns that have handily beat the market for decades. Next benefit is access to commercial real estate. Again, the main reason REITs were created was to allow everyday investors just like me and you to put their money to work in assets that would otherwise be out of reach. Most people can go out and buy a Class A office tower all by themselves, but there are REITs that allow you to do just that. Thanks to REITs, many people own a piece of hundreds of shopping malls, apartment complexes, data centers, and even the Empire State Building. Another good benefit is about portfolio diversification. Most experts would agree that diversifying your investment portfolio is a good thing, and although REITs are technically stocks, real estate is a different asset class than equities. Real estate tends to hold its value better than stocks during tough economies, and it's a great way to add steady and predictable income. These are just two of many factors that help offset the inherent risk of an all-stock portfolio. And the last but not the least benefit is about liquidity. Buying and selling real estate properties can take a while. On the other hand, REITs are an extremely liquid investment. You can buy or sell a REIT whenever you want with a click of a button. If you eventually need the money from your REIT, it's easy to free up your cash. That were the benefits, but no investment is perfect. Here are the potential drawbacks you should know before adding any REITs to your portfolio. First one would be about dividend taxation. REITs tend to have above average dividends and aren't taxed at the corporate level. The downside is that REIT dividends generally don't meet the IRS definition of qualified dividends, which are taxed at lower rates than ordinary income. As pass-through investment vehicles, REITs qualify for the new 20% pass-through deduction that was created as part of the Tax Cuts and Jobs Act. Even so, REIT dividends are typically taxed higher than qualified dividends. This is something to keep in mind if you own your REIT in a standard taxable brokerage account. Another con is about interest rate sensitivity. REITs can be highly sensitive to interest rate fluctuations. The key point is that rising interest rates are bad for REIT stock prices. Since price and yield have an inverse relationship, higher yields mean lower prices. If you open any chart of REIT and Treasury yields, you can see that REIT prices and Treasury yields typically move in opposite directions. REITs work best as long-term investments. In addition to interest rate fluctuations, there are too many factors that affect REIT prices over short periods of time. I generally don't suggest putting any money into REITs or any investments at all actually that you are going to need within the next 5 years. Longer time horizons are even better. While REITs can add diversification to your portfolio, it's worth pointing out that most individual REITs are not very diversified. They tend to focus on a specific property type, and each type of commercial property has its own set of risks and drawbacks. For example, hotel REITs are very sensitive to recessions and other economic weaknesses. If you choose to invest in REITs, it's smart to choose a few with different levels of economic sensitivity. You could also invest in a REIT ETF or mutual fund that spreads your exposure among different property types. So in total, REITs can be great additions to your portfolio as they can produce steady income as well as growth, which can translate into some pretty impressive long-term total returns. Just be sure to have a good understanding of how these companies work as well as the risks involved before you get started. Here are more other videos about personal finance and investments for you. Make sure to subscribe to the channel, smash the like button and hit the notification bell. See you in the next video.